Stagflation combines low growth with high inflation, and many people have been saying that we're about to enter a period of stagflation. So in this video, we're going to look at why that would be a bad thing, it's a particularly toxic combination, but also look back to the 1970s and draw some parallels, but also talk about the differences with that period and what that means about whether we're likely to get stagflation going forward. So let's look at stagflation in a bit more detail. Let's start by looking at what we mean by stagflation. Here we're looking at the growth of the United States in terms of GDP, with high growth here on the right of the graph, low growth here on the left, and at the bottom of the graph we've got low inflation or deflation, and at the top of the graph we've got periods of high inflation. And currently the United States in Q2 2021 is here. So growth is over 12% per year, which is extremely high, and at the same time inflation is also high at over 5%. What you can see is that the US economy spends most of its time in what you might call the Goldilocks zone of reasonable growth and inflation which isn't too high. But what people are worried about is that growth will really slow down, and at the same time there'll be very high inflation, and that's what we mean by stagflation. To see why that's so toxic for you and I, but also for our investments, first let's consider what low growth means. For starters, it means less job security for most people, because in a weak economy, you're much more likely to be laid off. And even if you do keep your job, there's also the possibility that you'll have very low wage growth. And as investors, what we'd worry about is that corporate earnings growth would also slow down during periods of weak GDP growth. And if that wasn't bad enough, we're going to combine that with a period of high inflation. That means that the cost of living is rising, and for many people, inflation will outstrip their wage growth. That means that in terms of purchasing power, their wages will be falling. And as income is eaten away by higher costs, we'd expect to see household disposable income also falling. Companies too would be affected by inflation because their input costs would increase, and as people are less likely to be able to afford price increases, they may take a cut on their margins. So all in all, stagflation is a terrible thing. If we go back to the GDP versus inflation graph, what I've done here is label each quarter which has the most extreme values of inflation and growth. The blue line here traces out recent macroeconomic history in the United States since the onset of the pandemic. We started off here in the Goldilocks zone, but very quickly the pandemic in 2020 and Q2 had a huge negative effect on growth. But fortunately that was quite short-lived, and we saw growth snap back close to the Goldilocks zone, and now we've seen it shoot back to very high growth of 12% as we saw, combined with fairly high inflation of just over 5%. But the worry is that we're now going to shift into much higher inflation and low growth after we see the bounce back from the pandemic. So that would be a path something like what we saw in the 1970s. So that starts off here in 1974 in Q1 with inflation of around 10%, and then it traces a kind of double dip into oblivion as it heads back into the Goldilocks zone for a while, but then in 1979 we head back up into even higher inflation, which peaked at just under 15% in Q1 of 1980. So this was not only awful for the US economy, it was also quite protracted. Now, if you're interested in a particular topic and you want a video made just for you, then our Patreon community can actually vote for me to make videos which only they have access to. So here's one on alternative inflation hedges, which I did recently. And to learn more about that, just click on the link at the top of the page, and there's also a link in the description of the video. So now let's look at the similarities between the current situation and what we saw in the 1970s. And a good place to start is with a spike in energy prices. This graph spans a period between 1965 and 1985, which was the period of very high inflation. Inflation is here in the middle panel, and that's the blue line that you can see. It peaked in 1975, dipped for a while, and then peaked again in 1980. The red shaded area is the Federal Reserve's monetary policy rate. Now generally the Fed will increase rates in order to reduce inflation, and the top panel shows you economic growth through this period. Now what's very noticeable is that there were two huge spikes in the price of oil in 1974 and 1979, and those roughly coincide with the periods of high inflation. That was the price of crude oil, but of course that has an effect on gasoline prices at the pumps. And the result was a 43% spike in gasoline prices in 1974 and a 69% spike in 1980. Both of those spikes were quite long-lived, but what's noticeable so far is that the current spike, which is up by 56% year on year, doesn't seem to have lasted as long as it did in the earlier episodes. But that may be because it's caused by different factors. In the 1970s, one of the contributing factors was an oil embargo imposed by OPEC against the United States and other countries. Now, at the time, the US was heavily dependent on imports of oil, much of which came from the Middle East. But what's happened since then, thanks to shale oil production in the United States, is that the US has now become a net exporter of oil. So if there is another crisis in the Middle East, the US won't be so heavily affected. So what I'd expect to see is that this spike in energy prices will be shorter lived this time around. Another similarity between the situation then and now is that government spending is increasing. Now, the 1960s was a period of very strong economic growth, combined with a fiscal policy of greater spending, certainly contributed to this spike in inflation. Effectively, the US government was adding fuel to the fire of growth, and that stimulated a big commodity boom. Part of the reason for that greater spending was the Vietnam War. Here you can see Lyndon Johnson talking to some troops. And at the same time, the Great Society plan from Lyndon Johnson was trying to eradicate things like racial inequality, but also poverty in America. And that came with greater spending. If we look at US spending relative to GDP, the biggest spike came with World War II, and Vietnam was more of a slow burn which increased spending gradually over this period between Eisenhower and Richard Nixon. And there are certain similarities between the pandemic and that kind of war spending that we saw in the past. It's money that the government has to spend in order to ensure the safety of its citizens. But whereas in the 60s the government was spending more in an environment where there was high growth, the purpose of spending during the pandemic has been to reduce the effect of the recession that we've seen recently. And it's certainly been successful in shortening that recession and reducing its effects. The question that remains is whether fiscal policy from the government and monetary policy from the Fed has been too effective and instead of creating growth, create lots of inflation. And the truth is, we don't really know which way it's going to go from where we are now. So now let's look at some of the differences between this period of high inflation, the Great Inflation as it's called, and the situation now, and why I think we're unlikely to get an extended period of inflation combined with low growth. One huge difference is that the Federal Reserve, the central bank in the United States, is fully independent. The chairman of the Federal Reserve in the 1970s was Arthur Burns, and currently we have Jerome Powell. Now, it's very well documented that Arthur Burns caved into political pressure from Richard Nixon. You can actually read the coercion line by line in the transcripts of Nixon's tapes. And in a book by John Ehrlichman, who is an assistant to Richard Nixon, he actually relates this conversation when Nixon was laughing about Fed independence. He's reported to have said, "I know there's the myth of the autonomous Fed," and he warns Arthur Burns that when he goes for his confirmation, he should be careful what he says about his friendship with the president. What this meant in practice is that Federal Reserve monetary policy was run to get Nixon re-elected, rather than trying to control inflation. So if you look above me here, you can see that the Federal Reserve was cutting rates from 1970 onwards, and that was very much at the president's behest. And the policy had its intended effect, which was to increase growth, but also to get Nixon re-elected. We can contrast that with Jerome Powell, the current chair of the Federal Reserve, who always stresses how important Federal Reserve independence is. Now, the reason for that is that the Fed will always look at the long-term best interest of the economy, without regard to the political pressures of the moment. Another big difference is that the Fed has the experience of the Volcker period. These are the minutes of a meeting in 1971 at the Federal Reserve, and what's pretty shocking is that Arthur Burns effectively says that monetary policy can't curb inflation. That's because he thinks raising interest rates would just increase unemployment, and that would have a negative effect on the economy without reducing inflation. Whereas today, the Fed is very much convinced that raising interest rates does have an effect on inflation. It can be an effective policy. Here's Powell in August 2021 saying that the Fed would certainly respond and use their tools to ensure inflation runs at their target rate. And that's because we now have the experience of the Volcker period. Volcker was Fed chair between 1979 and 1987, and he really needed to be independent. That's because what he did was very painful for the economy. You can see that the Fed policy rate increased almost to 20% during his tenure. So effectively, he switched off the credit markets and then switched them back on again. That reduced US growth, but it also reduced inflation. Another big difference is that we're unlikely to get a wage price spiral as we did during the Great Inflation. The first step of a wage price spiral is a spike in prices. What happened in the 70s is that wages also went up when prices went up. Once wages went up, companies were more confident that people could afford to pay higher prices. And that created this kind of feedback loop where prices chase wages and wages chase prices. Now, this positive feedback loop means that we can get runaway inflation, which lasts a very long time. This is the relationship in the 1960s between unemployment here on the x-axis and the rate of inflation on the y-axis. Notice that when the unemployment rate fell below 4%, we got this big rise in inflation. But what's truly remarkable is that that relationship, which is called the Phillips curve, has effectively disappeared since the 1970s. When unemployment is very low, as it was just before the pandemic, we actually didn't see very high inflation. So why has this relationship broken down? One reason is that union membership is much less common than it was in the 70s. The membership rate before 1980 was above 20%, and currently it's getting close to 5%. And while US productivity has gradually increased since the 1970s, if we look at worker compensation since then, that effectively hasn't increased anywhere near as much. Part of the reason for that is that the Fed is now willing to have a certain amount of unemployment to keep inflation in check. Whereas Arthur Burns, for example, was extremely keen to get people back into work at the cost of higher inflation. There have also been very few and infrequent increases in the US minimum wage, and cost of living adjustments, which used to be written into work contracts, no longer exist for most workers. And while the average worker receives less pay now, that's not true of senior management. In fact, the entire US tax structure favors those with the highest rates of pay. And at the same time, a lot of the deregulation since the 1970s has favored greater profits at companies rather than worker compensation. So the link has now been broken between higher prices and higher wages. And that means that this feedback loop between prices and wages has also now been broken. So that's why I think now we're much less likely to see a period of extended and high inflation. And I think growth is likely to be pretty good because the cost of borrowing remains very low. If a company sees higher demand for its goods and services, then it may want to scale up its operations, and it can do that by borrowing in the bond markets. Now, the cost of that borrowing is very important, and in the 1970s, you can see the cost of borrowing was above 10% for an average company. If we contrast that with the cost of borrowing now, you can see that it's at historic lows. And with credit easily available, I think that's certainly a good tailwind for growth in the years ahead. Another huge difference between now and then is that the US had just come off the gold standard. The Bretton Woods Agreement effectively ended in 1973, but that was a system whereby developed market currencies were kept in a fixed exchange rate with one another, but also with the price of gold. So that's why the price of gold was effectively constant until Nixon closed the so-called gold window in 1971. At that point, the dollar was no longer exchangeable for gold. Then in 1973, these relationships between the currencies also ended, and those currencies became freely floating relative to one another. And what followed was a rapid devaluation of the dollar. That meant that any goods which the US imported became more expensive, so it was certainly inflationary for the US. And when that was combined with the oil embargoes and the higher cost of oil, it led to this first great inflationary spike. But as we've seen, the US is now a net exporter of oil, and the situation is quite similar in the UK, which also exports quite a lot of oil. So what we don't have to deal with this time around is huge instability due to currencies moving from a fixed pegged system to something which is freely floating. So are we going to see stagflation in the US? Almost certainly not. How about Europe? Again, unlikely. But in the UK, I think it's a possibility. And that's because we have to contend with Brexit, which has exacerbated these supply chain problems, but also restricted the labour pool and made that wage price spiral much more likely, I think. But we'll just have to wait and see what pans out with the data. But remember, if you do want to support us, then you can do that via Patreon. Just click on the link in the description or on the link at the top of this page. And as always, thank you for listening.